Welcome everyone to Spark Reynolds podcast, YouTube, Facebook Live, and everything else that we're on in these things. Last week we talked about the gift of time, and this week a subject that I hear in the real estate realm of like the professionals and pretty much everywhere. Should you buy in the dip in the real estate craziness right now? So with that, make sure that you let us know where you're tuning in from. If you have any questions, pop them in there. And without further ado, Brian, why don't you tell us, let's start about timing the market, which so many of us try to do with our crystal balls.
Yeah. So, I hear homeowners and real estate investors alike talk about, trying to time real estate markets, trying to buy the dip. And with stock markets and everything else in anything else you can invest in. And so I want to start by just saying that trying to time any market is just inherently a bad idea. Like, I mean, there are so many reasons why. But first of all, you have to be right twice, right? Like you have to be right when you buying low, and then you have to be right again timing the market when it's high. So yeah, it just doesn't work in stocks. It doesn't work in real estate. It is gambling. So for example, I hear people say, "Oh, the next time there's a real estate crash, I'm gonna buy a bunch of properties, or I'm gonna buy a second home, or whatever it is." But the fact is, the next low point, in the next real estate crash, could be higher than today's pricing, right? I mean, the market could go up. And I'm not saying that that's what's going to happen right now, because home prices are cooling around the country as we speak. But just generally speaking, when someone says that, my response is, all right, so home prices could go up another 15% and then dip by 7%. And they're still going to be higher than today's prices. And you don't know, you don't have a crystal ball that's any better than economists or market analysts. The smartest, best informed experts in the world don't know exactly when markets will shift, how far up or down they'll go before they turn again. So it just doesn't make sense. And it's hubris if you think that you are going to be able to time real estate markets perfectly. And real estate is in some ways harder to time than stocks, because real estate is inherently illiquid. So it takes a lot of time and money to both buy properties and, again, to sell properties, as opposed to stocks, which you can buy and sell for free at a moment's notice. Now, that being said, real estate markets move in much slower motion compared to stocks. But yeah, given how illiquid real estate is, this whole notion of trying to time markets is just bad. Now, having gotten all of that out of the way, we can talk about buying the dip, and how it can kind of sort of make sense. Real estate is cyclical. It does sometimes drop in price. Like we just mentioned a minute ago, there are hundreds of cities in the US that are dropping in price right now. And we're actually, so we have every quarter we update an interactive map on cities where home prices are declining. And we're actually about to update that article later this week, and that interactive map. But I was looking at some of the data yesterday, and it's something like 250 cities out of the nearly 900 that Zillow tracks that are seeing declining prices over the last quarter. Now, it's a lot fewer than that are seeing declining prices over the last year. But that doesn't really tell you the whole story about market movements right now. First half of 2022 was very, very strong for real estate. And then markets go to a halt in the second half as high interest rates took a toll. So, yes, housing markets do sometimes drop in price. We're seeing that right now in many markets around the country, and that can create bargains, right? And as
do you think that because there was such a jump, like in my area, like a ridiculous, like it was kind of crazy how high things went. And now I'm seeing them sit on the market longer and definitely big time falling down.
Yeah, and the markets that jumped the most during and after the pandemic, a lot of those markets got distorted where they shot too high up, and now those are the markets that are crashing the hardest. Whereas some of the markets that rose more slowly and steadily during the pandemic, they're not taking the same kind of hit that cities like Boise or Austin, some of these high flyers during the pandemic, because they overshot the market fundamentals, right? So local median incomes could not support the home prices that some of those markets were seeing, and so they're crashing the hardest now. Whereas many markets will probably not dip at all over the next year, or if they do, they might dip a very small amount, but not the way some of those high flyers are going to come crashing back down to earth. So yeah, housing markets are cyclical right now. A lot of markets are seeing declining prices that can create bargains, and all investors should be on the lookout for bargains, just in general, right? So, speaking of home values being cyclical, we will put a link in the show notes to some graphs and just an overview of exactly how cyclical housing markets work and how housing market corrections work, like Denny and I were just talking about. So yeah, today's market is a little unusual. So it's being driven by high interest rates, and that is causing some markets to cool. But lower property prices still aren't that appealing if you have to pay super high interest in order to buy them, right?
Yes.
So it still costs you a bunch of money from a monthly cash flow perspective. You still may not, if you're a rental investor, as Denny and I are, and as many of us here who listen to this show are, those high interest rates are still going to put a huge dent in your cash flow, and so you still may not come out ahead. Now, you can come out ahead if you are buying in cash right now, right? Like lower property prices coupled with high interest rates doesn't have to be a net zero for you if you're not borrowing money to begin with. If you're buying in cash, that's all upside for you, right? So cash investors have an advantage right now. You can also get creative with lower interest financing. We just published an article today on that very topic, which again, we'll put a link to in the show notes here. But you can get super creative with this, between negotiating owner financing to things like house hacking for a year. So you get owner occupied mortgage interest rates instead of investor mortgage interest rates. You can do live-in flips. You can do all kinds of creative things to get lower interest rates than you would pay otherwise as a real estate investor. So consider some of those creative ideas. We're not going to go through all those right now. We've already done a podcast episode on some of those. So, but yeah, check out some of those creative ideas.
Rents are going up as well. So, technically there are some deals that you could buy even with higher interest rates that you still would come out ahead on.
Absolutely. So, and that's one thing that we saw. That was one of those market distortions that we saw in the pandemic and its aftermath. Was home prices shot through the roof, but rents actually didn't budge until the federal eviction moratorium ended. And then all of a sudden, rents started sprinting to try to catch up with home prices. So home prices are now declining in many markets where rents are still going up. And that equilibrium is still being determined. So as a rental investor, you can find some bargains right now in markets where prices are cooling, rents are still going up, and may continue to go up. Right. And in fact, this is something that, Denny, you and I have talked about many times before, how rents actually don't drop during recessions. Home prices often drop by 5 to 10% during recessions, but rents don't drop. They may flatline. For example, in the Great Recession, rents flatlined for a couple of years, and landlords can see other challenges such as higher turnover rates, higher eviction rates, higher default rates, and higher vacancy rates. So you can have some other challenges as a landlord, but rents don't drop during recessions. So you can at least count on the rents staying steady. If you're going out and bargain hunting right now for rental properties, you don't have to worry about rents falling off from under you when you're calculating cash flow. And
this also, I just want to mention, is so important for landlords to continually increase the rents, on a regular basis, because what I did see, and what I have been hearing, at least in this Pennsylvania area, is people who have been paying the same rent for, say, 4 or 5 years, even, through the epidemic, were increased substantially. And it was ticket shock. So
yeah, it's not fair for the landlords trying to often be like nice guys and, oh, I'm not going to raise the rent this year. I'm not going to raise the rent this year. And then 4 years go by and they realize that they're charging, 20, 30% less than market rents. And they're like, well, wait a minute, I'm leaving all this money on the table. So then they go out.
Or I'm losing money at this point.
Right. Yeah. So because your property taxes are going up, your landlord insurance is going up, all that stuff. So then they go out and they try to raise rents by 20, 25%, and that's just not fair to the tenants. It's sticker shock for them, like you just said, Denny. So instead of putting your tenants through that, and in many cases your tenants just won't be able to pay it and they'll have to move out, just raise the rents by 3%, 5%, 6%, whatever a year, as the market bears. And that way you can set expectations with your renters that the rent will go up every year, but we're not going to totally sticker shock you.
Mm-hmm.
It's going to go up by 5% or whatever a year, and it will be manageable. We're not going to hit you with a 20% or 25% rent hike, which is just not fair. So, stop trying to be a nice guy and just have just approach it like a business. And you'll find that you'll actually end up doing your tenants a favor by not falling into that trap.
And then for all of you that have trouble with that, or all the other things that are going on, maintenance issues, there are alternatives, right, Brian?
Yeah. So let's talk takeaways here, because and I want to tie back to what you just said, Denny, about some of alternative models for investing. But a couple of takeaways about buying real estate, during the dip or trying to time markets, buying while markets are cooling or cooler at the moment. First of all, like we just talked about, buy and hold real estate long term. Plan on buying for cash flow. Don't try to speculate on appreciation. So we have a free rental cash flow calculator. Use that. Find properties that cash flow well. These don't have to be sexy investments. They just need to cash flow well. So buy them, hold them long term. If there's a recession, no big deal. You just keep collecting rents, keep paying down your mortgage, let the property cash flow, and then in 5 years from now, 10 years from now, if you want to sell, by that point you probably have some appreciation. We will have long passed this cooler housing market that we're in right now. But plan on buying and holding long term for cash flow, not speculating on appreciation. Now, to your point, Denny, about alternative models of investing, as a stock investor, I am a big fan of the slow and steady dollar cost averaging. So, if I have an influx of cash, for example, from, I don't know, a tax refund, if I inherited money from great Aunt Sally, who I never met or something, I don't plunge all that money into the market immediately. I spread it out over time by just, every week, a little bit of money goes into my robo-advisor, and that way my returns will mimic the market returns. Not trying to place a big bet all at once or anything like that. Again, it's called dollar cost averaging, and it's just slowly and steadily plugging money into the market. Now, with real estate investing, that's hard, right? Because a down payment costs tens of thousands of dollars. So you have to spend a bunch of time saving up the down payment, and then you have to put all your money into one asset. So there are a couple of ways you can dollar cost average with real estate, rather than trying to time the market or having to plug all your money into a single asset. You can invest in real estate crowdfunding. In some of these platforms let you invest with as little as $10. So it's not like you have to save up a bunch of money in order to invest. You can literally just invest your, those lattes that you skipped over the next couple of weeks. You can put money towards real estate crowdfunding investments instead of lattes. If you want to get a little bit more serious about, well, that's the wrong way of putting it. But if you want to invest a little bit more, but far less than a down payment, Denny and I have a co-investing club where we invest in real estate syndications, and each of our club members can invest as little as $5,000 per syndication. And if you're not familiar with real estate syndications, they're basically fractional ownership in large apartment complexes. Is the very, very short and oversimplified answer. And typically these require a minimum investment of 50 to 100 grand per person. We go in as a club, so we can each invest with as little as $5,000 per person. And again, it makes it easier to dollar cost average, putting smaller amounts of money into multiple different real estate investments rather than having to put, $80,000 into a down payment on a rental property, for example.
And as part of the club, you get the, I like that there's different levels of experience. So you can almost even learn from some other people, and it's a cool experience.
Yeah, absolutely. We put in a couple links to real estate crowdfunding investments that you can invest in with very little money, and also a link to an article about real estate syndications and how they work. I also added a link to our co-investing club if that's something that appeals to you. But that's been my approach for the last year or so, is just every month, put some money to real estate syndications. And each one of those is a big apartment complex. So I have, very small fractional ownership in a bunch of different apartment complexes around the country. So it's a good way to spread out risk and not try to time the market. As we wrap up here, we want to leave you with a parting thought about housing as an investment in general, because a lot of people are, if you listen to the pundits, the sky is falling on real estate markets right now, right? And no one should ever invest in real estate, blah 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 blah. The simple fact is that the United States has a housing shortage. Now, experts disagree on exactly how many units that shortage is. So, for example, Moody's Analytics pegs that housing shortage at 1.6 housing units. Up for Growth did a study a year or so back that found the US is 3.8 housing units short. It doesn't matter. We're still talking about millions of housing units that the United States is short. And that's not going away, because housing starts have been declining for 11 straight months now. So this problem of the housing shortage is not ameliorating anytime soon. Here's one last statistic for you. So in the last 10 years or so, this is roughly from 2012 to 2021, there were 12.3 million US households that were formed, but during the time, only 7 million housing units were built. So, that's a shortfall during that decade of 5.3 million housing units.
Wow.
Yeah. So the bottom line is that, yes, housing markets are cooling at the moment, largely driven by high interest rates and the fact that some markets overshot their fundamentals during the pandemic. But real estate in general is very much a worthwhile long-term investment. We are not going to have a surplus of housing anytime soon in the US.
And everybody needs a roof over their head.
Everybody needs a roof. It's hard to argue with that. Denny, is there anything else that you wanted to touch on before we call this episode complete?
No, but I'm going to say something here about my Eagles. So go Eagles. And hopefully don't piss off people.
Right. Well, all right. On that note, go Eagles. My Ravens got knocked out in the wild card weekend. So, I guess I can get behind the Eagles. All right, guys. Have a great rest of your week and stay in touch. We'll talk to you soon.
Bye-bye.